Hello, this is Vicky Pryce again, back with the autumn update on Brexit and the economy. So, what's been going on? Well, internationally, there have been quite a lot of changes since we last spoke. US interest rates have come down because there have been increasing signs of the US economy itself slowing down. The Federal Reserve cut rates, and they may cut them more in the coming months before the end of the year. What we've also seen is slowing down in Europe too. The Eurozone has seen a significant cutback in industrial production in some countries. Germany itself went into contraction in one quarter. So the European Central Bank has stepped in. It has cut interest rates to even more negative for some rates. The ones that the banks deposit with it has now become more negative, which means that it costs banks to leave money with the central bank. So what they have is an incentive to go out and lend, which is absolutely essential. There's also been announcements of more quantitative easing starting again. We'll start with something like 20 billion a month in November. Of course, there is a change at the ECB. The head, Mario Draghi, has been replaced by Christine Lagarde, who used to run the IMF. The question is, will she be able to continue his policies of easing? And so far, the signs are that indeed she will. Then, of course, in the UK, where interest rates had been going up, we've had a bit of a sort of a stop to this for a while now, because no deal Brexit had become a bit more of a likelihood. And of course, the central bank has been worried about this. The Bank of England has actually announced now that it may be cutting rates even, or at least easing monetary policy, even if a deal is agreed. And of course, as we know, there are negotiations right now going on, and the chances of a deal have increased a little bit in the last few days. But what, of course, they would do if there is a no-deal Brexit is they would cut a lot more aggressively, a little bit like what happened after the referendum. So anything is possible. Looking ahead, we are in a very uncertain environment right now, and that uncertainty will probably remain until the very end of this month or even longer. Remains to be seen. But what's going on, of course, at the same time, is that everyone realizes that monetary policy can't do it all. Fiscal stance has to change too, so far, apart from the US. On the fiscal side, most countries, certainly the European ones and certainly the UK, have been following sort of austerity measures, more or less, or certainly quite tight fiscal control. And that needs to be rethought. What the European Central Bank has been saying is that they can't do it all themselves, and they need a bit of extra support, and there's a limit to what more monetary policy can do. And therefore, in Europe, certainly the whole fiscal stance will need to be rethought. The Stability and Growth Pact that exists now in the Eurozone, which puts very strict limits on countries' ability to be more expansionary, those need to be possibly rethought, and they might indeed be rethought. Then, of course, we have the whole problem of trade and the trade wars that we're seeing at present. World trade growth has really sort of stopped, more or less. The World Trade Organization thinks that we're not going to see more than 1.2% growth in trade this year. That's pretty bad. And of course, that is due to the trade disputes that exist, particularly between the US and China. But of course, there have also been disputes between the US and the EU, and those have become slightly worse now following the fines that are imposed supposedly on Europe because of the decision on whether the EU was subsidizing unfairly Airbus versus what's going on with Boeing. So competition rules were sort of broken, international competition rules. So we're just about to see quite a lot of tariffs imposed on the EU as well by the US on lots of agricultural products and some specialist products as well. So things don't look too good. And that world slowdown has affected, of course, a number of countries more widely, including in Europe and in Germany being affected significantly. And given that those countries are very substantial buyers of our exports from the UK, that has been a problem for us too. And then, of course, we have the Brexit shock, which is still there. And the question is, how big will it be? Although things look a little bit better, what we had seen until now, there was a lot of Brexit fatigue, but maybe that will be shaken by the recent discussions between the Prime Minister and other European leaders, as we've seen the last few days. But unfortunately, in the meantime, things don't look too good. What we saw in the second quarter is that UK GDP slowed down. In fact, there was a contraction in GDP. There have been worries that we might see another contraction in this quarter that has just finished. What nevertheless seems to be happening is that because July looked a little bit better, although August wasn't, August saw a renewed fall in GDP, we might end up with a 3 months more or less stagnant and not showing any contraction. So we might avoid a recession, a technical recession, but that's kind of comfort really, because the indications are that the underlying strength of the economy is sort of wilting, and there will be problems unless the Brexit issue is resolved quickly. With it, of course, and more significantly than month-to-month changes in manufacturing, construction and services and so on, is what's been going on the investment front. Every quarter in 2018 saw a fall in business investment, and there was a bit of a pickup in the first quarter. Remember, we had a lot of stock building and everyone was spending a lot of money trying to cover themselves for the deadline that we were having to supposedly meet for exiting the EU at the end of March 2019. That came and went, of course, and with it we had a lot of destocking. It's one of the reasons why we had a contraction in the economy in the second quarter, but also why investment again fell. The question is whether that has improved at all since. What we also saw, unfortunately, in that quarter is that productivity fell at the fastest rate for 5 years. So the economy is losing momentum, and if you have to be competitive in a world economy where things are already much more difficult in terms of the environment for exporting and importing, that makes the UK's position a lot weaker than would otherwise be the case. What is also happening is because of the reduced attraction of the UK as a place to invest, given the Brexit uncertainty, we've seen that foreign direct investment too has slowed down, and in the last 3 years to the end of June, which was the second quarter, the one we've been talking about now, there's been a 30% decline in investment volumes from abroad, and of course the employment created too has suffered. And we've seen a number of foreign firms, particularly in the car industry, cutting back production and also intending to no longer go ahead with some of the investment projects that they had announced they were going to do before in the UK, either moving them out to, let's say, Japan for some firms, or basically stopping them altogether. And we've seen the monthly changes in manufacturing, which have been quite disappointing. This is the manufacturing PMI that shows that anything below 50 is contraction, and that's unfortunately where we've been now for quite some time. So the indications are not very good, but obviously if you cut production of cars, for example, I mean, they've been going up a little bit again recently, but overall there's been a significant cutback in car production, anticipation of Brexit, and also car investment. Then, of course, that affects the sector as a whole, and if the export conditions are not very good, then that brings down manufacturing output, or the willingness of any output to be produced as well down. Look at construction. It's been a recession for a bit. You can see the last 2 quarters, how they've been affected. Again, construction is very volatile, and it's not always measured particularly well in the surveys that are done. Nevertheless, again, it's an indication of what is going on. If you add to that, of course, the latest housing figures, which are pretty poor, London seeing falls and the rest of the UK also seeing practical stagnation in house prices, it does give you the impression that something is going on in the UK economy. The brakes have come down very sharply, and people are just waiting to get some resolution of the Brexit issue, but of course not forgetting that the international world environment has got much worse as well. So what about the Brexit options? What lies ahead? We have had a new PM talking about a no deal and being very tough about it, although that has eased a little bit recently, as we've been hearing. There's also been legislation which is supposed to prevent that from happening, but the words again from the Prime Minister have not been terribly conciliatory to that, but he may well be stopped from having no deal. It may well be why he's keener now to find some solution to this, but he still wants to leave by the end of this month. The question is whether the new EU proposals that may come back after the summit that takes place in the middle of October, the EU summit, is passed through Parliament. That's a big question mark. And then, of course, we're left with a number of scenarios that businesses have to cope with. Either having no deal, which I think looks increasingly unlikely, whatever our Prime Minister has been saying, because he'll be stopped by legislation. Whether we have a deal, I would have put unlikely before, but now I would put possibly. It will happen, who knows? But even if a deal is agreed between the UK and the EU, and then it has to come back and be passed, there will be a lot of legislation that needs to be put through, and also the EU government agreeing it, so we may still need an extension, which is what, in any case, the Prime Minister would have to ask for if by October the 19th, according to the legislation that's been passed through Parliament, we have voted for nothing. Either we haven't voted the deal through, or we have not voted a no deal either. So extension is likely. But of course, that complicates the situation, because what happens during an extension? Are we likely to have perhaps another general election? Or will there be some stipulation that the deal is passed only on the back of agreeing that there will be a referendum to agree that deal? That could delay things again. So if one is looking at it as an economist and trying to forecast it, it's difficult enough. If one is a business trying to decide what to do, I would guess it's even more difficult. And it does suggest that stagnation is the most likely outcome looking ahead. So I mentioned a referendum. What will happen? It's interesting that more recent polls, in fact, quite a lot of them suggest a margin which is a reasonable, not huge, but reasonable margin in favor of remaining. It's interesting when you look at demographics that it is, or has been nearly, through all the age ranges, it is really the older generations that have tended to vote more for Brexit, in other words, the Leave vote, and the younger ones that have tended to vote the other way. Much depends on the demographics, which have changed a bit since the last referendum, and of course, the willingness of the young to go out and vote. So it's not clear what the outcome will be, but there are suggestions that if there is one, we might end up with a vote to remain. But of course, how the whole campaign will be run, one isn't certain at present, and anything could happen. It is worth reminding ourselves that a no deal has very substantial negative repercussions for the UK. Most forecasts are quite pessimistic about this, and they also think that even if there is a free trade agreement after a withdrawal deal is agreed with the EU, that will also be negative for the UK economy. So we're not talking about a resumption of very fast growth. There could be a lot of optimism in the short term, but it's unlikely to lead to a resumption of fast growth or of investment in the future. And really, we can see that in relation to confidence. Under some measures, business confidence and consumer confidence are at the lowest levels for 10 years. It's interesting about the consumer in particular. We sort of suspect it for businesses, but the consumer is still enjoying record employment, and yet they are not certain about their own positions or about the future. And that is affecting many sectors, like the retail sector, for example. And if you look at profit warnings, they are at quite a high level. They certainly were at one of the highest levels for ages in the second quarter. So something is going on, and the consumer's reluctance to spend, I think, has influenced quite a lot of those trends in industry and various other sectors. What is happening, of course, in terms of trying to help that and ensure that the economy grows a little bit faster than it otherwise would, is that there's been a lot of willingness from the government to spend more. The Chancellor The new Chancellor has already indicated he's prepared to relax the fiscal rules. For the moment, he's got some room for manoeuvre, but not very much. He has partly reversed austerity. Finally, we're having all departments seeing an increase or no cuts, something that hasn't happened for the next year. That's something that hasn't happened for 15 years. The Chancellor may need to borrow more if the economy slows down further, and there have also been some estimations of what the deficit is that makes it actually a little bit harder for him to stick to his rules, but I think the markets are prepared to lend for the moment. Despite the fact that austerity supposedly is finished, what the Chancellor announced just recently in terms of extra spending for this coming year only really brings us back at something like 3/4 of offsetting the cuts that have been introduced since the austerity first was introduced in 2010, so we've still got a bit of a way to go. Frankly, if you look at how people voted, the areas that suffered most from austerity were also the ones that originally voted UKIP and then voted Leave in the referendum. Now, of course, the debt levels are already high. Brexit will make it worse. You can see how we have collected an awful lot more debt than we had probably anticipated 10 years ago. But of course, the financial crisis is to blame. The good thing is that because of low interest rates, we're paying practically the same every year as we did when we started this process of sharply increasing our debt. What I think is quite likely to happen is because of Brexit, whichever form it has, the improvement that we're hoping to get perhaps from here on isn't going to happen as fast, or in fact could be reversed. And this is because a lot more support is likely to be needed and probably will be forthcoming, not only if we have a disorderly Brexit, but under any type of Brexit scenario. But if we do have a no deal, what the Institute of Fiscal Studies has suggested is that borrowing perhaps even for next year might be 50 billion. In a couple of years' time, it could be 100 billion. We may therefore be borrowing a year, something like that, which is considerably higher than any earlier estimates. And of course, that increases the debt to GDP ratio very significantly. I don't think the government has any choice. The Chancellor has already announced quite a lot of spending for next year, as I mentioned earlier, which brings him up to, if you like, the limit of what he can do, but probably he will need to do more. What we've seen is not just a question of the current spending, which is going up, but also quite a substantial increase in capital spending, which is intended to happen over the next few years. And that is actually quite good because productivity is helped by this, but it will put strain on the debt again. And we are likely to see tax cuts already hinted in the forthcoming budgets because obviously there are concerns about growth. The OECD, the Organization for Economic Cooperation and Development, to which we belong, which is the club, if you like, of developed economists, has forecast that even with an orderly Brexit, we're going to grow by 1% this year, next, more or less, and we'll have a contraction by 1% at least a year for the next 3 years if we have no deal. Well, in that environment, I think we'll get extra help from the monetary side. The Bank of England has said that it will cut rates and increase liquidity, even if we have an orderly Brexit. So, to finish, how will we fare in the future? Because, of course, we've had a financial crisis. There's been quite a lot of strengthening of the banks in the period that followed. And, of course, there have been loads and loads of stress tests that the Bank of England has carried out. And it looks at bank resilience under the worst case scenarios that you can find, including very substantial cuts in house prices and so on, and corporate failures and what have you. What it believes is that, at least on the financial front, which is so important to ensure that remain stable, the banks and the insurers, or major ones in any case, can handle a worst case scenario, disorderly Brexit, and also they can handle a trade environment which is considerably worse. They know that a trade war can damage the global economy. The question is how the UK can survive. But at least from the UK financial side, in terms of support to the economy and preventing any of the failures of the type that we saw in the financial crisis 10 years ago, the Bank of England believes that they're now strong enough, they can withstand it, and that the services that UK households and businesses will still need will be able to continue. So I'm ending with an optimistic note. A lot can happen in the next couple of weeks. But maybe soon some of this uncertainty will lift. Thank you very much.